Hello, welcome to Module 7, Lecture 1. Module 7 is going to deliberate on cash flow technique, which is one of the most extensively used technique of financial statement analysis based on actual basis of accounting, and it is popularly adopted by all the users community having varied interests and objectives so far as the financial statements of the corporate world is concerned. In this lecture, we are going to debate and discuss about the essence of cash flow analysis and why the stakeholders community or the users community are so relying on this particular technique of financial statement analysis. When you are going to talk about financial statement, it is prepared on the basis of accrual basis of accounting. When we say accrual, we are taking into consideration all those items which are related to a future span of time. Simply say, for example, when you are going to talk about payment of salary, but some portion of salary remain unpaid. When you are going to go by financial statement and its preparation, we are considering that as outstanding salary and we are showing it in the financial statements as if we have paid it, because by charging it to PL account we are reducing the profit. But on the contrary, the cash flow analysis is based on actual orientation, where we are not going to consider all those items which does not lead to any flow of cash. Now, moving further, when you are going to talk about cash flow as a technique of financial analysis, it is essentially digging out the different sources from which cash is coming into the business, popularly known as cash inflows, and the different ways in which cash has been utilized in the business in the performance of different activities, which is popularly known as cash outflow. It is essential to unfold different objectives. Say, I have made a mention of the same. The objective is to determine how effectively the business generates cash to meet its commitments, finance its operations and facilitate growth. Whenever we are talking about a business, we all know cash is otherwise representing the lifeblood of a business. Without the availability of cash, pragmatically it is not viable to execute different activities on a day-to-day basis. So, it is of immense importance at the end of the users community to dig out and to evaluate whether sufficient cash is available at the disposal of the company to meet all those financial obligations, may it be day-to-day recurring obligations, may it be short-term obligations, may it be long-term obligations. So, cash flow as a technique of financial statement analysis has been sensitively and prominently used by the users community to separately study the flows of cash in terms of inflow and outflows. Moving further, the cash flow analysis enumerates the net effects of various business transactions on cash and cash equivalent by taking into consideration receipts and disbursements. Just I said the same thing, when you are going to execute any activity, it is going to have a bearing on the cash or cash equivalent items which are finding a place in the financial statement, may it be the balance sheet, may it be the additional information. Now, here it is imperative to talk about what is cash equivalent, because that is one of the significant aspect of cash flow analysis. Now, cash, we all know what it is. It is the most liquid form of resource which is available at the disposal of the company to undertake any activity and use cash as an instrument to make payments. But on the contrary, when you are going to talk about cash equivalents, they are not available on readily usable form. Rather, they represent those investments or instruments wherein cash has been invested, but at the same time it can be converted into cash without any shrinkage in its value within a very short span of time, and as and when there is the requirement of cash in the business organization. So, for example, marketable securities, short term investments, the balance lying with the bank, they are almost readily possible to be converted into cash whenever the company or the business is in need of cash in order to meet its financial obligations. Moving further, when you are going to talk about cash flow as a technique of financial analysis, we are there to pay due consideration to the contributions which cash flow as a technique is going to provide to the users community or to the stakeholders community. We are going to discuss the same within the significance of cash flow analysis. To start with, the first is demonstration of liquidity. We all know what liquidity implies. Liquidity simply implies the ability of a firm to meet its short-term obligations or the day-to-day recurring financial obligations as and when they will become due. Now, it is essential on the part of the users community to unfold whether sufficient cash is available at the end of the company in order to meet all these obligations which are accruing as a consequence to the performance of different activities in the business. Now, in the absence of liquidity, obviously the day-to-day operation of the business is going to be at a halt because of non-availability of cash. Say for example, if you do not have sufficient cash to pay off the expenses which are emanating from the laborers community, definitely they will not be available to render their services to the company if they are not getting regular payments in the form of cash at the end of every day. So, this is a very simple example which simply justifies how sensitive the availability of cash is going to be for the business when you are looking at the business and its performance on a daily basis as well as in the near future orientation. Now, coming further, it is a disclosure of operational health. Obviously, when you are going to talk about operational health, indirectly we are talking about the level of operational efficiency or the effectiveness and efficiency with which different activities related to different functional domain of a business are getting executed. Now, without sufficient availability of cash, different activities, say for example related to marketing, related to administration, related to R&D, related to HR are not possible to be executed in an efficient manner, and whenever we are lagging in terms of performing different day-to-day recurring activities, obviously it is going to have a significant impact on the operational efficiency, leading to an unfavorable consequence on the operational health of a business. Moving further, cash flow analysis also facilitates assessment of risk. We all know a business in general is exposed to two different genres of risk. One we say is the operational risk, the other we say is the financial risk. Now, when you are going to talk about operational risk, obviously whether the company is in a state to take off all the operating activities related to different functional domain on time and in a position to execute and perform all such activities with the minimum possible time and as and when there is the need for the execution of those activities. That reflects the operating risk. So, in a sense we may say that if a company is having sufficient cash at its disposal, then the operational activities related to different functions are not going to be, in a sense, are not going to be restricted, or we may say that there is going to be perpetual performance of different operational activities in the business. Moving further, when you are going to talk about financial risk. Financial risk is essentially the risk of default. With sufficient availability of cash, there is no issue pertaining to financial risk, owing to the simple fact that the risk of default tends to be nullified. Whenever there will be due in terms of financial liabilities, may it be related to creditors, may it be related to purchase of raw material, may it be related to any other execution of activities, if the company is having sufficient cash at its disposal, then the company would be in a position to almost avoid the prevalence of financial risk. Moving further, when you are going to talk about strategic planning, obviously strategic planning is taking into its ambit different market pervasive forces which are not within the control of the company, but the companies or the corporate world are there to face all the challenges which are hailing from the market sensitive movements, may it be economic factor, may it be social factor, may it be political factor, may it be specific business factors, whatever they may be. The companies are there to face it off by devising strategy in a proper way so that they would be able to come up to the expectations of the stakeholders community in terms of handling those challenges emanating from the macroeconomic orientation. But at the same time, if cash is not going to be available, it is pragmatically very difficult on the part of the companies to come out with any effective strategic plan so that they would be able to win over those negativities of the market. So, cash is very sensitive when you are going to talk about strategic planning. So, for example, here I may quote that all the companies are resorting to the task of preparing cash budgets on a monthly basis, on a quarterly basis, on annual basis. And the very purpose of preparing a cash budget is some way or the other contributing towards the policy making and the strategic planning of the company. Moving further, cash flow analysis also facilitates projection of future liquidity. We all know that for the preparation of cash flow, at least we are there to have the financial statements of a company for 2 consecutive years. Now, when you are going to consider the financial statement of 2 consecutive years, we are more or less into a retrospective analysis using the cash flow technique. But that is going to talk about what the company did in the past or what the company is doing right now. But when you are going to look at the varied interests and objectives of the users community, they are not getting restricted to the present or past. Rather, they are more concerned and interested to know what is going to happen in the future of the company, whether in the near future or in the far future the company would be able to maintain sufficient liquidity, indirectly whether the company would be able to generate sufficient cash through its operations to meet out all these current and near future obligations or not. So, cash flow analysis also contributes towards digging out whether and to what extent the company is going to maintain its liquidity in the near future or in the far future. Moving further, after having discussed the significance of cash flow analysis, let us get into the usefulness of cash flow statement. When we are going to talk about the usefulness of cash flow statement, the first usefulness is facilitates clarity on cash flow. We all know that there are thousands of activities which are getting executed in a large business organization on a daily basis. If you are going to accumulate all those activities which are getting performed in a particular company during a particular financial year, that may be in lakhs. If you are going to take, say for example, Tata Group of Industries, there the number of activities or the transactions which are getting executed in the Tata group of industries are going to be in lakhs. So, there may be lakhs of activities which leads to cash outflow. There may be at the same time lakhs of activities which leads to cash inflow. But the financial statement, which is also considering all those transactions which are getting executed in a particular business, doesn't pay heed to the flow of cash. So hence, the cash flow analysis provides clarity with regard to the use of cash in different activities, the ways through which the cash is generated in the business in the form of revenue, and it clearly decomposes all the transactions getting executed in the business into two sections, one which leads to activities pertaining to cash inflow and the other are activities pertaining to cash outflows. By doing so, the users community would be in a position to see how the business is executing all these activities. Down the line, we will be discussing the technicalities of preparation of cash flow analysis. Here, in cash flow analysis, as an introductory orientation, let me make a mention of the fact all the activities of the business have been decomposed into three broad categories when we are going to talk about cash flow analysis. The first one is, say, operating activities, second one investing activities, and the third one financing activities. All these genres of activities have different significance and have different bearing when you are going to talk about the financial well-being or the financial affluence of a company. So it is imperative on the part of the users to unfold all those activities in terms of cash inflows and outflows so that they could better appraise the status of liquidity of a company. Moving further, the same thing decomposes inflows and outflow of cash. Just now I said that cash flow as a technique of financial statement analysis clearly distinguishes activities leading to cash inflow and activities leading to cash outflow. And by doing so, the extent and the magnitude of window dressing or manipulations while executing different business transactions seems to be negligible, because here we are following the actual basis as the modus or as the underlying premise while we are talking about cash flow analysis. Moving further, it aids in decision making. Obviously, when it is considering within its ambit the whole of the transactions getting executed in a business, there may be some decisions which are related to the day-to-day recurring activities. There may be certain decisions which are related to procurement of fixed assets. There may be some decisions related to procurement of capital. There may be some decisions related to executing investments in the form of different assets, just to magnify the capacity and capability of a company to generate revenue, and so on and so forth. So, if we see to the business in general, each and every activity is backed by a decision, because without doing so, it is not practically possible to come up to the expectations of the users community, and at the same time it is not possible to ensure efficiency and effectiveness in the performance of different activities related to operating, investing and financing orientations. So, every execution of activity precedes a decision, and cash flow as a technique of financial statement analysis contributes heavily towards the task of decision making, and it facilitates the users community, both internal as well as external users of financial information, to execute decisions in an informed and rational way. Then the next usefulness is it evaluates financial agility. When you are going to talk about financial agility, we are reflecting upon the sharpness or the swiftness with which a company is handling its financial obligations. There are different practices which are available nowadays in the corporate world in order to ensure financial agility. But at the same time, whatever may be the activity, you can be in a position to execute it in a timely and efficient manner, provided you have sufficient cash at your disposal. Because without the availability of cash, it may so happen that you are getting an opportunity, say for example, to buy raw material from the market at a lesser price because of a deflationary pressure in the market, as a consequence to which the raw material is now available in the market at a lesser price. So, to grab that opportunity, to show that agility or swiftness, you should have sufficient cash at your disposal so that you would be able to buy the same raw material at a lesser price, and down the line you can be in a position to reduce the cost per unit of output, and you are in a position to optimize the extent of profit. But these are all possible provided sufficient cash is available at your disposal. So, financial agility is essentially accruing from the availability of cash, and we can say so rigidly in a sense that without the availability of cash, it is practically not feasible to show financial agility. Because if you are taking time in terms of making payments, if you are not effective enough to convert your current assets into cash swiftly, then obviously there will be cash crunch in the business, and the financial agility is far from its availability, because financial agility is conditional upon the availability of cash. If a company is going to experience cash crunch, we can never think of financial agility in that particular company. So, cash flow analysis digs out in a proper and scientific manner whether the financial agility in a business prevails or not. Then the next is it unfolds red flags. Red flags more or less leads to all sorts of misrepresentations, manipulations, window dressings, which are very common nowadays in the corporate world, just to create a fantasy before the eyes of the stakeholders community, because the stakeholders community are more interested to know about the favorable orientation of a company, and accordingly they are taking their decisions. But on the contrary, the companies are going otherwise. They do not want to disclose their negativities or unfavorable issues before the users of financial information. So, they are heavily resorting to all sorts of manipulations, window dressings and misrepresentations, might be deceptive disclosure, might be following very disruptive accounting practices when they are executing different activities. So, that can be in any form, but the question is whether cash flow analysis is going to curve on these activities to which the companies are highly exposed to. The answer is yes, because cash flow analysis completely separates different activities on actual basis in terms of cash inflows and cash outflows. So, when you are going to make use of cash flow as a technique of financial statement analysis, obviously there is very little chance of manipulation. We are not saying that the chance of manipulation is absolutely negated by the preparation of cash flow analysis or cash flow statement using cash flow analysis. It cannot be outrightly avoided, but at the same time we may say that the extent and magnitude of financial manipulations can be reduced to a larger extent when you are going to talk about the use and application of cash flow as a technique of financial statement analysis. Moving further, whether we are talking about the cash flow as a technique of financial analysis or any other technique, it is always imperative to discuss about the loopholes or the impediments which are associated with these techniques of financial statement analysis, and cash flow as a technique of financial statement analysis is also not free from impediments. So, it is essential on the part of the users community to make themselves aware of the limitations of cash flow analysis, and essentially what are those areas where the cash flow is not serving the vested interest and objectives of the users community so far as financial aspects and decision making is concerned. To start with, it overlooks non-cash transactions. As I said, cash flow is a technique which is based on cash basis. So, obviously, we are not going to accommodate those transactions where cash is not involved. But in a business, pragmatically, there are many activities where cash is not involved, but they are very sensitive so far as the financial worthiness or financial affluence is concerned. Say for example, if a company is acquiring fixed asset by issuing shares to the vendor of the fixed asset, obviously the acquisition of fixed asset is going to significantly contribute towards magnification of the revenue generating capacity of the business. But if it is ignored outrightly, what is normally done while preparing the cash flow statement? Somewhere or the other, we are ignoring very sensitive activities which are getting executed in the business and contributing significantly towards the very objective of the business in a holistic manner, but cash flow fails to accommodate those transactions. Moving further, it is not a measure of profitability. Why do we say? Because when we are talking about profitability, there may be the prevalence of many transactions which leads to inflow of fund or which leads to revenue so far as a company is concerned. But if that revenue is not getting received in terms of cash, rather it is received in some other ways, then that is not finding a place within the ambit of cash flow statement preparation. So, the way we calculate the operating profit within the domain of cash flow, it is not a reflection of true profit or the profitability of a corporate entity. So, there are contentions and there are assortments with regard to this particular point, whether the profit ascertained through financial statement reflects the profit making ability of a company in a better way, or the operating profit ascertained through cash flow statement is going to reflect the ability of a company to generate profit in a better way. These are contentions, and there is no consensus with regard to the two dimensions of calculating the profit making ability of a company. Moving further, it is also subject to interpretations, because cash flow, when you are going to talk about all the cash flows, may it be operating, may it be investing, may it be financing, it requires heavy quantum of interpretation, and when we are relying on interpretation, the same fact can be interpreted by different users differently. Say for example, dividend paid, it is an item which is treated under financing activities, but the users may interpret it differently. In a sense, one user may say that the company is not having liquidity opportunities to invest with, that is why the company has paid heavy dividends during this financial year. On the contrary, another user may be having that interpretation that, look, the company is sufficiently paying dividend to attract the potential investors to invest in the shares of that company. So, there are differences so far as the interpretation is concerned. So, it is mostly subjective in nature. That is why it is one of the inherent limitation of the cash flow analysis. Moving further, as we are talking about liquidity, it is more or less restricted to short term orientation, and it does not talk about the far future in general. Moving further, when you are going to talk about the timing of cash flows, here there prevails time differences, and the time value of money is completely ignored when you are going to talk about the prevalence of whether cash inflows or cash outflows, because the cash inflows and outflows are related to recurring activities which are getting spread on a daily basis throughout the financial year. So, a cash inflow related to the month of April is not going to be equal to that of the cash inflow related to the month of December, provided the amount in terms of money remains the same. So, there lies differences, but cash flow analysis completely ignores the time differences. The last limitation is it is prone to manipulation. Obviously, there are different ways and means like leading, lagging, delaying intentionally the payment in terms of cash, or not receiving from the vendors or the suppliers. So, there are different practices which are used by the corporate world just to manipulate the cash flow statement. So, the extent and magnitude of manipulation, though it is less in cash flow statement compared to financial statement, but the probability and the possibility of manipulation is there also in the context of cash flow statement, which are falling under the purview of cash flow analysis. Now, to conclude, when you are going to talk about cash flow analysis, it is completely governed by one of the accounting standard which is issued by Institute of Chartered Accountants of India in our country, who has given clear guidelines with regard to the modus operandi of preparation of cash flow statement within the ambit of cash flow analysis. So, that is indirectly facilitating a comparative orientation owing to the simple fact that all the companies are mandatorily required to prepare the cash flow statement and also mandatorily required to disseminate the cash flow statement before the stakeholders and users community, so as to facilitate them for informed and rational decisions. Thank you for your patient hearing. That is all about the introductory on cash flow statement.